Here we are, folks. Hello, hello. Another Tuesday evening. Welcome, welcome. Good to see everybody on, and enjoyed the pre-show conversation tonight. So we just put the pre-show monocle up just to say that we're not quite on the main show next, but we will be running very soon to that. And the dogs are here, of course. Here's a they look so tidy, don't they, in their beds, as though nothing could ever happen other than just they go to sleep. But actually, they got wet this morning and were a little bit dischuffed with that. But anyway, they are happy now. Nice warm studio, and hopefully will be quiet for the remainder of the show. We'll see. And just to give you a bit of a view, here's the studio. Of course, nobody coming in on chat tonight via YouTube. It's just me. But I've got my screens up and everything running. Chat's up there, multi-view, the other screen there for my content. And over there, I've got my streaming computer controls as well. So everything's running, and should be an interesting conversation tonight. I see a few postcode questions already coming up. We'll get to those a bit later in the show. So thanks for that. So I'm going to take the pre-show off. I'm going to run my introduction, and I'll start the main show. Back in a second. Well, good evening and welcome to the live stream here on the 12th of March 2024. Martin North here from Digital Finance Analytics. Great to have you on the show, and it's just me this evening. I'm going to be talking through some of our latest analysis and also some of the latest news relating specifically to property. A lot going on, of course, and a lot of conversations we can have. And there'll also be time to look at some specific postcodes and see the detail down at that granular level, because as you know, I quite often say, I'll say it again, granularity is really, really important. Anyway, just to explain before I go any further that these shows are not specific financial or legal or property advice. It's a matter of playing nice in the chat room, please. I realize that date's not updated. My apologies for that. But if you'd like to use at Walk the World to get my attention, that's the best way to get your questions into my stream. I've also enabled Super Chat, which means that if you want to get your question top of the list, you can do that, or indeed make a contribution to what we do around here. And I will just say, as I always do, I really appreciate the Super Chats. They really help just to cover some of the costs. We don't do this to make money. We do this because we think there's a really important conversation to have. There are costs involved in making these shows, and I really appreciate the support I get. It makes a huge difference on my ability to be able to run the shows the way I want to, and to cover all the topics that I think are really important. And there is a lot to talk about at the moment. You know, things are definitely grinding on. A lot of different points of view there. So I thought I'd do three things tonight. Firstly, I'll just cover some of the headlines that we've seen over the last few days and interpret them. Secondly, I'll do a very, very brief summary of my stress analysis, but I have made some separate shows beforehand, which I'll mention a bit later, where I've gone into more detail. I'll then share some new information relating specifically to defaults and to net investment yield. And then towards the end of the show, we'll look at individual postcodes. So that's the agenda for tonight. And to start up, why don't we look at some of the headlines that have been up over the last few days. Cookie Boy has been great. He's been throwing me a lot of information. Cookie Boy, I couldn't do this without you. Thank you very much for all the info that you're sharing. It's great and really helpful to me. And the point, I guess, to start with is, of course, there are people saying property prices booming. You know, the latest from CoreLogic said that things were on the up, although actually, if you look carefully, not universally. And in fact, in Melbourne, things are going sideways, and in Tasmania, they're going backwards. But of course, a lot of people are saying that inflation can't stop further rises in home prices. And despite the high debt to income ratios, et cetera, and the high rents, there is a question as to how much more legs property prices have in their run-up. And as we'll see, it does depend on where you look. However, there was some very interesting discussion overnight actually, relating to this question of should you be using superannuation to support your property purchases. And there was published information from the Super Members Council, and they, in their modelling, surprise, surprise, found that actually if you pull money out of superannuation, it might put home prices up and reduce the amount of superannuation that you have when you go into retirement. Now, of course, they are as objective as anybody aligned to the superannuation sector would be. But I think it's an interesting point of view and different, of course, from what some others are saying with regard to the use of super. The bottom line is that you're going to bid prices up. The more you put incentives in the market, the more you're going to bid prices up. Another interesting piece of information came from the HIA. Labour is talking about financial incentives to encourage employment as an apprentice and to improve retention, and they welcome that. As we've said before, the problem, Edwin covered this with me yesterday, the problem is that we actually have a situation where, frankly, there is not enough labour to build the 1.2 million homes that the government is targeting. So frankly, even if they want to, they probably can't. And of course, we've had this debate before as to whether you bring more people into Australia, specifically with the skills to be able to build more, to be able to actually meet the bigger demand, because we've got high migration. Maybe a different migration strategy would make more sense. But hey, that's probably too straightforward and easy. But I think there's a point there. Another one, of course, is that, as I reported the other day, this is a very important article, people are finding that the apartment route is not necessarily as powerful as perhaps people thought. It isn't a trap, potentially. Values haven't gone up. It's still expensive to buy in. And of course, you've got all of the poor construction quality, particularly in apartments. And around the place, the fact of the matter is that there's a big problem. And interestingly, Mirvac is saying they're now targeting apartments not to first-time buyers, but to people who are trading up to different chunks of the market, which I think is quite relevant too. The fact of the matter is a lot of people don't necessarily want to live in high-rise. And just another little data point, new home loans are falling. That's across the board, whether you're looking at owner-occupier investment or indeed first-time buyers. That was a bit of a surprise. People didn't expect that, but actually it's beginning to bite. People are finding it harder. Loan-to-value ratios are actually under pressure, but more importantly, of course, the other thing that's really different now is the amount that people can buy is driven by the borrowing capacity that they have. The borrowing capacity is significantly down, and whilst lenders are willing to lend, in certain circumstances, they're being a bit more picky, and that's really having quite an impact on those who can get into the marketplace. Another piece of information that came out was that some Chinese people are now offloading property because they're finding it difficult to keep up with repayments. Now, others are arguing, well, maybe that's not too surprising, but they have been quite an active set of purchases in some markets, particularly high-rise actually, and so that could actually have an impact ahead. And another piece of data just worth re-emphasizing again is we've got more people working multiple jobs to try and get by. I see that in my surveys. One of the really interesting things here, a lot of first-time buyers are actually working multiple jobs, in some cases 2 or 3 or maybe even 4 jobs, just to try and generate sufficient income to be able to get in. Why? Because many first-time buyers are really keen to get into the market, not least because, of course, rentals are running through the roof, and that means that there's a lot of interest from first-time buyers to try and find a way in. The problem is quite often I see them buying property that probably is not very good value in areas that potentially have risks attached. And if you're buying high-rise apartments in some of the outer suburban areas, it's worth remembering that in some areas prices haven't risen since 2017. In some of those areas, I refer to the article earlier about those purchasing from overseas. Another interesting observation is that the rental crisis is still there. It's getting worse, whether that's Sydney, whether that's elsewhere like Queensland on the Gold Coast, or if you look at Adelaide, wherever you look, it's a really, really difficult story. And the point I'd make here is that the momentum with regard to rents is still quite strong. And if you look at the data on new rents versus the ABS data, you'd expect there to be continued pressure on rents going forward over the next little while. And what that means is that the inflationary impact of those high rent rises will feed into inflation, and that might put a brake on the RBA's ability to cut rates as quickly as many in the markets have been predicting. And of course, if you go back a few months, a lot of people were predicting March. Well, now it's maybe June or maybe later in the year. What happens is also going to be driven by what happens internationally. Of course, the Federal Reserve meets next week. We've got a CPI data coming out from the US later, and that'll be quite interesting to see whether the inflation is stronger. It might well be stronger than people expect. So there's a lot of momentum here with regards to why inflation may be higher for longer. Next thing I want to cover quickly is this rather scary thought. This is actually from Tasmanian Labor, who said that they're going to offer a shared equity scheme with no deposit as part of their state election campaign. I'll remind you again, all of these demand support mechanisms simply lift prices even higher. Now, of course, in Tasmania, prices have dropped quite considerably. In fact, it's the area that's currently leading the markets down in terms of value falls, and I'll show you some data on that a bit later. But the whole concept of being able to throw more money at people to allow them to get in, and shared equity is also a bit of a risk, of course, because you're assuming that prices will continue to rise. What happens if they don't? And how does that work? So I'm quite skeptical of these sorts of schemes, but guess what? They're, of course, political. And a lot of the discussion around property at the moment is political rather than, I think, dealing with the long-term issues. And that's a scary thought because, of course, we've seen that for the last 20 years. One reason why prices are higher than perhaps they should be is because of bad politics. But hey, that may not change. We'll see. Another one here is that people are saying in some cases the inflation rate could be set to rebound higher. So whilst inflation might be looking like it's under control, at the Financial Review Business Summit, there was a suggestion that rates could still be higher for longer and inflation could reassert itself, particularly because of supply chain disruptions. Now, there are some conflicting views about that, but the fact of the matter is that it's not set and certain that the RBA will be able to cut rates, and a number of the economists are still saying that they won't do anything until they get into 2025. And of course, they're not expecting to be back in target until 2025. So it's a way down the track. And whilst in some other countries, inflation is more under control, a lot of the inflation in Australia is homegrown. It's driven by bad policy around the rental sector, bad policy around power, electricity and gas, and of course, the issue that we are so exposed to the international situation. And China, of course, is pretty weak at the moment with its economic momentum. That's going to have an impact too. If we move on and just to cover a couple of the things, the latest Roy Morgan showed that confidence was up very slightly, but look at the trend. It's still way, way down from where it was. Been lower now than it's been for a long, long time. So consumers are definitely feeling it. And as was recently reported, mortgage stress hits its fastest pace in at least the last 2 years. Mortgage arrears are up and the delinquencies are most acute in Western Australia. And I'll show you some data on that a little later. We are seeing it now come through. And people have often asked me, why is it that the mortgage stress analysis I do is not turning up in delinquencies? Well, there's been the lag. There's a very significant lag between the delinquencies and people struggling with initial cash flow, and we'll talk about that. It can be several years. And a lot of the issues in Western Australia are actually to do with what happened not in the last 2 or 3 years, but actually earlier on when prices rose, then fell, and they may be rising slightly, but a lot of people are being caught by the earlier commitments they made. So that's a pretty important story too. And it's interesting that the Council of Financial Regulators, and I'll show you that in a second, has said that mortgage hardship is higher. The Council of Financial Regulators, of course, is the Reserve Bank, ASIC, APRA, and the Treasury sitting around the table and chatting about what's going on. And they're basically saying that the Australian financial system could be exposed to the lending to household problems. There is still some hardship. Hardship has risen. The increase in the share of households who've fallen behind with loan payments from historically low levels are going up. And the bottom line is they're starting to call out some issues. I thought it was also very interesting that they mentioned commercial real estate. Stress in overseas commercial real estate markets could be transmitted to domestic markets. And they also mentioned that the commercial real estate market in Australia is potentially more risky. And that was reflected in another article. Investors in listed properties are in for a bumpy ride over the next 18 months. And that's because, of course, we've had a major change in terms of use of property, particularly in CBD areas. And, that's a big deal, I think. So commercial real estate is probably the canary in the coal mine. And one other little headline, which I thought was worth highlighting, Australians are spending half their income on mortgage repayments, according to a very recent report. And that was in news.com. And also Philip Seuss made the tweet here that median advertised rents still rising dramatically. Rents have doubled compared to household income, while the vacancy rates have declined. And that really leads us very nicely into our discussion about what's going on vis-a-vis the mortgage and financial stress and rental stress. So we're going to touch on that now. Let's just do that by reminding ourselves once again that the method that we use here is to look at our surveys. We run these surveys all the time, and we put a lot of information together to be able to construct a story about what's going on. Now, we can slice and dice the data lots of different ways, and that means that we can look at it at particular areas, particular segments, and those sorts of things. And that granular analysis is really important. And if we can also then take the story forward and begin to think about where things might go, we can run some scenarios, and we talk about those scenarios again in a bit more detail later. The scenarios are not predictions. They're just showing you what the sensitivities might be like. And a core market model, therefore, looking at mortgage stress, the price trajectory, the buying and selling intentions, the migration information, the broader economics, goes into the core market model, runs through the scenarios, and that allows us then to look at information at a state level, at a regional level, or indeed at a postcode level. And that's, of course, the basis of our modeling. And as with all of this, I'll share you some of that information today, and we'll go into some specific information at a postcode level. And I will just make the point that the one-to-one service that we offer, where you can go into a deep dive on a particular postcode or suburb, is still available. This isn't financial advice, but this is actually analysis, just like I've shown you, at that individual level. There is a cost involved in doing this. You can have a conversation with me via Zoom or by a phone for an hour or so. There is a cost because there's a lot of work to be done to put all this information together, and we're booking ahead 3 to 5 weeks, and you can contact me via the blog if you're interested in that. Now, let's move on to a very important subject, because what the real interesting question is, so what is the stress? How do you define stress? And that's really an important question, because there are lots of different information out there, lots of different definitions. My definition of stress is cash flow based. It's not based on a 30% of income or even taxable income. It's not based on specific underwriting metrics that some of the banks might use, but we define stress in cash flow terms, money in, money out. If households have more outgoings, excluding one-off discretionary items and income, we define them as stress. Because, of course, if they go on spending more than they're actually earning, eventually things go wrong. If they've got a mortgage, they're in mortgage stress. If they're renting, they're in rental stress. And investors possibly will have cash flow pressures, and we can identify them as stressed investors. And we can look at the total financial stress in a particular area as we aggregate that up. And we can talk as a percentage of households or the count. But as I've said before, and I think it's worth reiterating again, one of the critical issues for me is the rule of big numbers. Where are the big numbers of households in difficulty? Because you could have a postcode with a very small number of households, and even if quite a lot of them were stressed, it wouldn't actually be economically significant. It would be very significant for those individuals, but less economically significant. But if you've got lots of households in a particular area, and that is a big volume, then it has economic significance. So I tend to speak around the counts rather than the percentages, although I do have both data sets. And as I mentioned before, I do actually have a few shows that I made over the last couple of weeks. There was a show called Pop Goes My Budget, when I went through the high-level analysis in some detail to be able to share the mortgage stress information, the rental stress information. So check that out if you want to get more data than I'm showing today. I also made a show making the point that even Roy Morgan, who's a different method of measuring stress, also said that mortgage stress was rising. And then I did a show a couple of days ago called Mapping Mortgage Stress, when I did the deep dive on the maps showing how each geography in the main area centres are actually distributing stress. So if you want granularity that I'm not going to cover tonight, go check those shows out. They're still up there and they did quite well. But more broadly, if I talk about stress, this is the RBA slide that says, well, you could have mild stress where you've got budget pressures, you've got missing payments, therefore delinquencies, and then you have severe stress turning to insolvency. And of course, insolvency then leads to forced sales and things like that. I measure stress at the mild end, so at the budget pressures, because budget pressures is where it all starts. And a lot of people will find that if they do have budget pressures, they might be okay for a period of time. And many households have been hanging on the assumption that rates will come down, their incomes will grow in real terms, and everything will be fine. But the longer it goes on, the more the rates stay higher for longer, the more difficulty they have. And what we're now starting to see, as I mentioned earlier on, is that some of those budget pressures are now turning into missed payments, and some of those missed payments are now turning into delinquencies. And that's despite the banks doing everything they can through their hardship schemes and elsewhere to extend and pretend. So in some cases, the banks have been able to offer an extension to existing loans on low interest rate terms, or have restructured the debt, extending over a longer period, or going interest only, all of those things. Trouble is, you end up with households paying more over a longer period of time. So it's not necessarily a very simple and straightforward story. So now let's look at the stress summary for February. So this is the basis, the latest data. And we're going to start looking at the rental stress, because the rental stress for me is it's a real big problem. You can see it's gone really, really high. 73% of households in the rental sector are having cash flow pressures. Doesn't mean they're missing their rent payments, but it means that they're cutting back elsewhere to do so. And in some cases, they're eating less, getting less medical attention, or indeed having to cut back in other ways. Some of them have given up paying health insurance. Some of them have actually started to tap into buy now, pay later, or indeed other short-term loans to get by, or put more debts on credit cards. But that's not necessarily sustainable. And of course, as I said earlier on, rents are still going up. Now, mortgage stress is still quite high. It's continuing to rise. It's around half of households, compared with 32% before the COVID period. And you can see that acceleration. Mortgage stress is not uniformly spread, as we'll see a bit later, but it's still rising. And that's a pressure. And it's worth just saying that the RBA is still reporting that the debt-to-income ratios are very, very high. And that's a real problem, of course, because whilst you've seen, if you go back 20 years, the debt ratios were lower, they're now very high. And it's also worth exploring this a bit further in saying that, of course, the RBA calculates this for all households, not just borrowing households. So the real number is a lot higher. And the average debt-to-income ratio is probably 5, 6, or 7 times. And there are a number of new loans that I've seen recently written where the debt-to-income ratio is 7, 8, and 9 times. And in some cases in Sydney, we're up to double figures. It's remarkably high. And that means that a greater proportion of income is going to pay that mortgage. And that, of course, then leads to difficulty later if, in fact, rents and rates and interest payments on mortgages continue to go high. Then you see these high levels of stress across the system. Now, I will just show you this slide. This is actually the average across the states. And I won't go through this in a lot of detail. If you wanted to, you can go and check out the other show. But I will just make the point that it is actually Tasmania where we're seeing significant pressures, with 59% of households in mortgage stress in Tasmania. That's risen quite substantially in recent times. We're seeing where in yellow, it's gone up from last month, higher in the ACT, Northern Territories and Tasmania, slight drop in New South Wales, Queensland, South Australia and Victoria. But overall, more than half of households, or more than 1.7 million households, are in mortgage stress. Look at the rental stress one, high and higher in several states there, Northern Territory, Queensland, South Australia, Tasmania, Western Australia, and higher across the board, with more than 2.2 million households in rental stress. Investor stress has gone up significantly, other than in Queensland and Western Australia, where it eased back slightly. And about 666,000 stressed investors are looking to perhaps sell or to put their rents up to try and deal with that financial pressure. And overall financial stress at 48% of households is translating to just over 4.7 million households. So of 9.7 million or thereabout households, you can see that it's just under half of households having difficulty. And I'll make the point that this amount of pressure is significant, and that's one of the reasons why we're seeing the economic pressures significantly worse than previously. And I am of the view that this is something which we're going to see playing out. Incomes are still not really growing in real terms for many. The costs of living are still going up. Inflation is still very much a thing. And therefore, the household's ability to be able to manage this is a real question. Now, I'm not going to go through the individual data at a state level or indeed at a particular category level this time. That's all available in my earlier show. But I want to go directly to this slide. Mortgage delinquencies reach the highest pace in the last 2 years. And the thing about this is, and it's what I said earlier on, but I just want to reiterate it, Western Australia is where a lot of the problems are. So let me show you this slide, which is actually the delinquency as calculated. Now, when I calculate delinquency, I start from a point of view of today and look ahead over the next 12 months. And I just want to highlight where I think the delinquency is the most significant. And you can see here that the one at the top of the list is Cranbourne in Victoria, where you've got more than 4% risk. And that's nearly 1,000 households at risk over the next 12 months. Then we go to Western Australia, the area around Mandurah. And then we go to Hoppers Crossing and Tarnett in Victoria. Western Australian postcode 6164, Success, and Armidale, and so it goes on. Also, I'll make the point that places like Gosford and the Central Coast is also registering quite high, with 500 or more households at risk there. And then up in Queensland, Pacific Pines. One of the real observations here, a lot of this is high growth. A lot of this is also basically driven by what happened, not in the last year or two, but what happened 4 or 5 years ago, why Western Australia is definitely a major problem in some areas. And I'll also make the point that as you go down the list, you can see there are regional areas like Toowoomba's on the list, and also Mackay and other areas in Queensland. So Queensland is also a hotspot. Now, there's another way to look at this particular information set. And to do that, if I switch across to this particular picture. So this is actually the stress mapped story looking at defaults. So basically, I've taken that data that I showed in the table, and I'm going to start with Melbourne. I just want to highlight where those hotspots are, where the default levels are actually standing out, both to the west, the north, and the east. And the hotspot center of gravity is in this area between Frankston and Casey. And you can see there that the default estimates with the dark red colors are 700 and above. Now, if you were to drill into that a bit more closely, you can see that as you go in, the defaults are somewhat lower. But of course, if you look at the center of Melbourne, there are more households there who are renting rather than in property ownership. Now, if I then go to another area, let's go to the areas around Sydney and do the same story, and we'll start looking close in. Again, we have the same issue. If you look close in, the total number of defaults is relatively low, but if you pull out, you can actually start to see some considerable changes. And the default levels are, of course, much higher as you move out towards the west, but in and around Sydney, compared with Melbourne, the default levels are not as high. I think that's quite an interesting observation. Now, why is that? Well, firstly, in some cases, banks have been a little more accommodating in and around the Sydney region compared with Melbourne. Secondly, the pressure on households in Melbourne have definitely ramped up over the last year or two, thanks to some of the state policies in and around the story there. And the other factor is that in some cases, property prices have risen more significantly in and around Sydney compared with Melbourne. So they do have more capacity with regard to the equity in the properties. So I do think Sydney and Melbourne makes a really interesting compare and contrast. Now, if we were to go across to Perth and look at defaults, again, what's interesting is that closer into the centre of Perth, well, there's a few more. But if you actually then start pulling out, you can start to see that there are areas where the counts are quite a lot higher, north and south of Perth. So 6065 and 6164 and 6112 are default hotspots. And if you pull out a little further, again, what you can see here is that the story is quite interesting. And if you go down to Mandurah in the south, you can see that there's a real hotspot in and around Mandurah. Now, there's a bunch of reasons. A lot of the properties were bought earlier on. They were bought for investment purposes, in some cases for own occupation elsewhere. But the values have not actually recovered specifically well. The payments are very high now because the mortgage rates have got up dramatically. And quite a few of the pressures here are to do with the incentives that were placed in Western Australia a few years ago, as well as those around the more recent COVID episode. So it's a pretty interesting story. And that's why I agree with some of the other analysis, like from Moody's and Standard & Poor's. Western Australia is potentially default capital at the moment. So watch that space. And I will just do one more. I'll go up to Queensland and just give you a bit of a sense there. And again, the story is a little bit easier in and around Queensland. But you can see there are a few areas where we're getting into the yellows and the slightly darker yellows as you pull out. But again, you're not seeing massive default levels until you go out as far as Toowoomba. And Toowoomba stands out as being a very significant pressure area. And if you go then south of the Gold Coast, you can also see 4211 is another hotspot. So my point about this default story is it's not uniformly spread. It's moving quite fast, but there are some areas where it's actually going to be a significant story ahead. And so these default stories, although they're still relatively low relative to what some people were expecting to see, are starting to turn in a way that I think is quite concerning. And it'll be interesting to see whether in fact Perth continues to show those default trends, or whether they turn around because prices are still rising in Perth, or whether we're going to see a catch up in Sydney over the next little while. I'd also make the other point, the banks don't want to foreclose, and a lot of people are being encouraged to get out of their property early. So, they'll try and restructure the mortgage, they'll try and go interest only, etc. But at some point, there's a conversation between the bank and the property owner to say, well, maybe you should sell, maybe you should get out. And with the equity that they've got, there's sufficient equity to repay the bank and maybe even to walk away with a little equity. So in some cases, one of the other reasons why defaults are so low at the moment, although rising, is because the banks have actually been quite accommodating, but also quite forceful in terms of trying to convince people to go and get those properties on the market and get them shifted. And I think we're going to see more of that, because the fact of the matter is that this is a story that is going to continue, I think, over the next little while. Now, there's one other thing I want to touch on just before I start looking at postcodes in detail, because one of the other questions that I get quite often is what's happening to net rental yields. And net rental yields are a really important story for the investment sector. And just to be clear, gross rental yields are a comparison of the price of the property versus the theoretical rental return that you can get by way of income. Put one over the other and you get a percentage. and maybe 3 to 5%. Net investment yield is the return after you've allowed for the cost of the property. So that's things like mortgages, repairs, things like management fees, if you have management fees, etc., etc. So the net investment yield is a really critical element to look at in the context of the way this plays out. Now, of course, there's a separate question about equity growth, because there are some investors who say, well, I don't mind making a loss because I can basically offset that loss against my other income and reduce my overall tax. That's, of course, the gearing question, and also the negative benefits that you get from the way that the tax system works. But what's interesting is that more and more people are now beginning to wake up to the fact that from a cash flow perspective, investment properties don't necessarily work very well. And as I'll show in a second, the story is very different when you look at different locations. We're going to start in Melbourne, because one of the things you may have noticed recently is the rise in the number of properties that are actually starting to list. And as I said to Edwin yesterday, a lot of that is ex-investment property. And here's the reason. If we look at this particular story here, this is actually the average net rental yield by postcode based on my surveys. And what you can see here is that there are areas in the blue where they're getting 0.9% and above. But there are also lots and lots of areas where you're seeing significant returns minus 0.13% and below in the dark red areas. And this is pretty shocking, because what this says is in lots of areas of Melbourne, we're actually seeing investors losing money on a cash flow basis. Now, as I said, you might be able to offset it with some of the tax breaks that are there. But nevertheless, if it goes on, then you probably will turn around and say, well, maybe I should actually think about selling the property. One of the reasons why that's, I think, happening at the moment. Now, keep that in mind if we then look at Sydney in comparison. And again, what I'm doing in Sydney is looking at the net rental returns. And what's fascinating here is that close into the city, you can see that there are areas also where, in fact, now net rental yields have gone negative. And you can see here, even in the eastern suburbs, even in the more affluent areas. But if you go west to places like Fairfield, or up to Hornsby, or down to Canberra and Bankstown, again, the net investment returns are looking pretty shocking. And I think that's very interesting, and it's changed quite fast in recent times. So if you look at places like Penrith and Camden, there's a lot of net investment negativity, and there are a lot of investors now getting a bit twitchy as to know what to do. So Melbourne's the worst. Sydney is not particularly flash. What about Queensland? Well, if we go to Queensland, it is quite a different story. Remember, the blues are positive, the reds are negative. And you can see there that if you look around and about, there are a few negative areas in and around Brisbane, but mostly the returns are positive, and in some cases the dark blue is 0.9% and above. So the fact of the matter is that many households who are renters are looking at Queensland as a place to go. And then we might just look at Perth for comparison purposes. And again, the story in Perth is quite similar insofar that there are lots of areas, particularly close into Perth, where in fact the returns are positive from a net rental yield perspective. However, if you look a little more closely and you go north and south, then the story starts to change. And those same postcodes where we thought high levels of mortgage stress, we're also seeing now investor stress. So this is, I think, a very important story to explore, that many property investors are living under negative net cash flow terms. And the question is, how much longer will they continue? Even in Western Australia, even in the area where capital appreciation is still quite strong, there is potentially a problem. Now, if you believe that the capital appreciation will more than wipe out the losses that you're making on a return basis, then you might still hold the property. But in the case of, say, Melbourne, where there is almost no capital appreciation currently, then that suggests you should sell. And that's one of the reasons why we're seeing a lot of people in and around Melbourne now putting some of those investment properties on the list. And I'd also make the point, of course, up in Queensland, they've increased the rules around what you need to do to be able to keep an investment property running. And in Melbourne as well, there are also rules that have actually encouraged more people to do more things to keep their properties up together and all those things, all of which are costs. So there's a really, really important story here. And I guess the story I've got to tell you is, again, go granular, because these slides show you that not all postcodes are behaving the same way. And, you know, I keep saying this, but I can't really reiterate it enough. Postcodes are not all behaving the same way, whether you're an investor, whether you're a renter, whether you're an occupier. And therefore, the overall financial stress, when I aggregate all that information, varies by postcode. Which sort of takes us quite nicely then to the individual analysis that we can do. And of course, as I've explained before, I think we do have the ability to be able to look at individual postcodes and look at what's going on. And if we have a look at that here, so this is my postcode engine, and this is looking at the information at a postcode level. And the way that I display this, and this is my most granular analysis at a postcode level, is I look at, and I've got my famous postcode Wollongong 2500 at the moment to look at. We understand how many households there are and what they're doing, whether they're borrowing or renting or investing. We've got the percentage that are in difficulty: mortgage stress, rental stress, investor stress, and aggregate financial stress. We've got the property mix information. We've got the people ratio. In other words, how many people are they per average property? And that tells you something about whether they're individuals or families. The bigger the number, the bigger the family, as it were. We go the vacancy rates. We've got gross investment yields. Like I said, net investment yield minus 0.4% in Wollongong. And then we've got our scenarios relating specifically to where property prices may go. Now, talking about scenarios, it is important to understand that the scenario story is dependent upon what you think is going to happen. And that's, of course, a critical question to understand. And I want to just quickly pop back and revisit our scenario story, because scenarios are a way of exploring different futures and thinking about the consequences. They're not forecasts, but they're showing you sensitivities. None of these scenarios are probably going to be right, but they do actually help to sensitize our models. And the scenarios at the moment we've got the best scenario, the Goldilocks zone, as I call it, that basically you've got a 4.35% cash rate, falls through the second half of 24. Inflation eases ahead of what the RBA says. Wages rise faster. There's no recession in Australia, and migration remains above average. The second one is a soft landing, where you have stronger rates that stick around. Inflation falls but begins to bounce back again, and it stays above target until 2025. We don't get a recession in Australia, but we do have a little bit of an easing back of migration. And the third scenario that I run is a nightmare scenario where you've got a rate rise, so that will put mortgage rates up even higher, stay high through 24. Inflation stays stubborn, unemployment rises, wage growth stalls due to recession locally, rates fall later because they cut, but it doesn't work that well, and migration also drops. Now, of course, you can run a lot of different other scenarios. For example, how much government intervention might there be? And could you actually see significant government intervention in the nightmare scenario? Yes, you could. And that would then change the outcome. But I do those merely to make the point that it is important to understand how these things may play out. So if I then go back to this particular story, and this is, again, looking at Wollongong, you can see there that I have the three scenarios mapped over the next 3 years, 12 months, 24 months, and 36 months. This is cumulative movement. And here, in the best case scenario, houses could still be higher over the next 3 years, say 5% higher. Units, pretty much the same, maybe not quite as strong. And the base case is a fall, not significant, but enough to notice. The worst case, if things go really pear-shaped, are more significant. Now, probability is that we're going to be playing somewhere between the best and the base case. And I do expect governments to intervene in the markets, of course, to help prop stuff up. But the fact of the matter is, it is very much a question of precisely how this is going to play out, and very importantly, what the story is with regard to the way that things will develop and what government policy will be, and of course what the RBA does. And to an extent, the RBA is going to be exposed dramatically to what may be happening in and around the local area as well as internationally. So with that out of the way, let me now just start picking up some of the postcode requests. Bossman asked for 4510, so let's put that in. Okay, 4510 is the postcode, and I will just take that off so that you can see it. So this is postcode 4510. It's in the Moreton Bay North area and includes Beechmere, Caboolture and Donnybrook. And there's 20,000 households with 26% owning outright, 35% borrowing and 38% renting. Mortgage stress is at 10%, not too bad. Rental stress is very high at 90%. And you can see here that overall aggregate financial stress is around 44%. A lot of the properties are houses, around 83%. The people ratio is 2.43%. That means it's houses with people rather than just sole occupiers. The vacancy rate's at 7%. Gross investment yield is 4.5%. Net investment yield is positive, 0.8%. So that's one of those examples where Queensland is showing positive returns. The taxable income from the ATO is about 62,000 and the household census 68,000. That gives a disposable monthly income around 4,400, with around 43% going on the typical mortgage at 1,900 and 36.6% going on the typical rent at 1,619. Home price trends, the best case scenario still rises ahead over the next 3 years, 9% cumulative. For houses, units just slightly lower. The base case, a bit of a fall, 10% over 3 years, slightly less for units. And the worst case, if it were to come out, more significant falls. But as I said, I think the best and base is probably where the bulk of the argument is likely to be. So that's that one. Got another request here from Patrick 2251. We'll do that one first. So this is McMaster's Beach on the Central Coast. And here, let me just take you off screen again so that we don't have a problem with the obscuring the answer. 2251. So we've got 13,000 households, 41, 40 and 17. So 40% are borrowing, 41% owning outright, smaller rental sector there. 37% of those in mortgage stress with the mortgage, 84% in rental stress. So again, rental stress a problem. Mostly houses, 82%. And the people ratio is 2.2. Gross investment yield is 3.5. Net investment yield is minus 0.5%. And the taxable is in the 80s, giving a disposal monthly of about 5,000, with more than half going on the average mortgage. Remember, I showed you that headline previously. Half of income going on the mortgage. Yep, here's an example. And 44% going on the typical rent. That's more than $2,200. From a scenario perspective, if things went really well, there would still potential for a rise, maybe 5% over the next 3 years. But the base case is a bit of a fall. And obviously the worst case is a more significant fall if indeed things went even more pear-shaped. And you also asked for 2260. Let me just do that one. So this is another Central Coast postcode in the area of Wyong, and includes Foresters Beach and Terrigal. And there you've got 9,700 households, 38% own outright, 40% borrowing. So there's a lot of mortgage debt sitting up in the Central Coast. One of the reasons why I called this out as a problem area. 21% renting, 23% are borrowing with mortgage stress, 91% of renters in rental stress, and 78% of houses, more units in this area. Of course, there's been a lot of redevelopment up and around, for example, Terrigal. And quite a lot of vacancies because quite a lot of the property here is also second homes and also Airbnbs. Gross investment yield is 3.4. Net investment yield is minus 0.6, so people are underwater. Taxable income, 93,000 from the ATO, that's an individual. The household is 112. The reason it's higher is because households here have multiple incomes. Translates to the monthly income of around $6,600, with 45% going on the typical mortgage at more than $2,900 a month, and the rent around 38% of income, or $2,500. And looking at the scenarios, a rise of around 5% for houses, best case scenario over 3 years, base case scenario, a bit of a fall, and the worst case, a more significant fall. So that's definitely what could be happening. We will see what we see. And, I update this information on a regular basis. Some of the information driven from the from the surveys and from the census doesn't change that much. But what does change is the significant momentum relating potentially to the story around mortgage stress and rental stress. And that's updated every month. And as the costs of living rise, as I've said before, we would expect to see significant rise ahead. Now, Drew has asked about postcode 3337. Let's put that one in. Okay, so this is in the area around Bacchus Marsh. It's the west of Melbourne, and that includes Melton and a few other areas around there. 14,000 households. 25% own outright, 47% are borrowing, 27% are renting. Mortgage stress is at 41%. The rental stress is at 51%. And the overall financial stress metric is at 35% for financial stress across households. 91% of houses, small number of units on the types of property. People ratio is quite high, so it's families rather than individuals. The vacancy rate's relatively low at 5.6%. Gross investment yield is 3.3%. Net investment yield is a little lower, minus 0.3%. Taxable income's around 67,000 on the individual basis, or slightly more at a census level. For the household, at 76,000. Gives a disposal monthly around $4,100, with 39% going on the average monthly income, monthly repayment for the mortgage, 1,846. And a third, $1,600 going on the typical rental payment. Looking at the scenarios, on the best case scenario, properties pretty much are flat or slightly falling over the next year to 3, and the same with units. But of course, the scenarios are more significantly going south in the base case or the worst case. And as I've said before, probably the scenarios are going to be somewhere between best and base. I think worst is probably less likely unless we get some externality biting in. Okay. Cookie Boy has asked for 2296. This is Islington in the Newcastle area. Now, I will say here, this is a very low count. You see the indicators come up to say it's a low count. So that's just worth bearing in mind. As with low counts, it may be a little inaccurate, but it gives you a sense of a read anyway. 47% of renting, 31% of borrowing, small number of owner outright. A lot of mortgage stress. Now, with a low count, this might be a little bit off, but you can see there's quite a lot of people with difficulty there. The rental stress is, reasonably high. Overall financial stress quite high. Just over half of houses, quite a lot of units, and a lot of other types of property. And that can be residential property over retail, for example. It can be other types of property too. People ratio is a bit lower. That include perhaps some individuals as well as some smaller families and older people. Vacancy rates 9.6% on the high side. And the gross investment yield is 3. The negative investment yield is minus 0.9%. Average taxable is around $75,000 for the individual and $95,000 for the household. And that gives you a disposal monthly around $6,000. with 39% going on the mortgage, just over $2,100, and 35%, $2,142 going on the typical rent. And from a scenario perspective, well, there is a scenario that says we could see a small rise in property values, maybe 6% over the next 3 years for houses and slightly less for units. But the base case is a bit of a fall over the next 3 years, and maybe 13% over 3 years and 4% in the next 12 months. Okay, next one to look at is 6401. This is in the area of Kalgoorlie, and it includes quite a few different areas, quite a big area, of course. You can see there from Buckland through to Throsell. And 3,000 plus households, 37% are owning outright, 33% are borrowing, 28% are renting. And of that, 55% are in mortgage stress, 63% are in rental stress, overall financial stress at 39%. Most of them houses, 93%, small number of units and other types of property. People ratio is a bit lower, so probably will include some individuals as well as families. The vacancy rate's very high at 15.9%. Now, this, of course, was at census night, and there could be some local circumstances that explain that, but that's still quite a high number. Gross investment yield is 3.5%. Net investment yield is plus 0.2%. And looking at the taxable income, 74,000 for the individual and 65,000 for the household census. So, it's in that sort of late 60s, early 70s, giving a disposal monthly around 4,200, with 36% going on the typical mortgage, 1,560, and 29%, $1,245 a month going on the typical rent. And looking at the price scenarios, well, there is still a scenario that says prices could rise. In the best case scenario, maybe 13% over 3 years. Units, not quite so much. The base case is a bit of a fall, maybe a fall of 6% over 3 years. That gives you a bit of a flavour of what's going on there. Okay, Jump for Joy has asked for 6027. So this is in Western Australian postcode in the Wanneroo area and includes Belden, Connolly, Edgewater, a few others. 16,600 households. A third own outright, 45% are borrowing, 22% are renting, 37% in mortgage stress, 73% in rental stress, overall financial stress at 40%. 85% are houses, some units and other types of property there too. People ratio is quite high, 3.29, so that's families rather than individuals. And the vacancy rate is 6%. Gross investment yield is 4.1, net investment yield positive 0.4. Average taxable from the ATO was 84,000. And from the census, 104,000. That's a household level. Translates to a disposable monthly income around $6,100, with 38% or $2,400 going on the typical mortgage, and 30%, 1,894, going on the typical rent. From a scenario perspective, if you believe the best case scenario, then there's still a rise of values over the next 2 or 3 years, maybe up to 14% over 3 years cumulatively. The base case is a small fall, and the worst case is a more significant fall. Okay, Cookie Boys come back with postcode 2008. And that's Chippendale in Sydney. And there we've got 4,800 households with 11% owning outright, 14% borrowing, 73% renting. And small amounts of mortgage stress, but massive amounts of rental stress. And because of the high levels of stress, investor stress is very high at 73%, giving households in financial stress a massive 86%. That's pretty high. You can see there that pretty much it's all units or other types of property, only 0.9% houses. It's a very different type. Very high vacancy rates at 17.3%. And you perhaps postulate that this could be in a city, so student land, and maybe a lot of students were away when this was done because, of course, the census was done in the direct aftermath of COVID. 3.9% is the gross investment yield. Net investment yield is 0.1%. Average taxable is around 86 to 90. And that gives a disposal monthly around $6,400 with 48% going on the mortgage and 40% at $2,616 a month going on the typical rent. Looking at the scenarios, you can see there that the story is the best case scenario is a small rise of 3% over 3 years. The base case, a fall of about 16% over 3 years with 5% in the next 12 months. And the worst case, a more significant fall. Okay, Greengrass asks for 6430. Which is another one in the Kalgoorlie area, goldfields, and includes Lamington and Somerville and South Kalgoorlie. Here we've got 8,000 households with 17% owning outright, 43% borrowing and 39% renting. A lot of mortgage stress, 88%, 3,100 households. Some rental stress, 38%. Overall financial stress, 61%. 80% of houses, small number of units and other types of property. People ratio is a little higher, 2.19, so that's probably some families there. Vacancy rate was also quite high, as I've explained the reason for that. Gross investment yields 4.4%, net investment yields 1%. Average taxable 94,000 for the individual from the ATO, 126,000 from the household census, suggesting multiple incomes are going to pay the mortgage. Gives a disposal monthly around $7,800 a month, with 26% going on the typical mortgage, just over $2,000, 19% going on the typical rent at $1,544. Of course, the costs of living are very high out there, and that's one of the reasons why the cash flow pressures are quite significant. From a scenario perspective, best case scenario, a rise, let's say 12% over 3 years. Base case is a fall of about 7% over 3 years and 1.5% over the next 12 months. Worst case, a more significant fall. Okay, Helsinki says 3931. Okay, so this is in the Mornington area and includes Mornington, of course. 11,000 households with 43% owning outright, 34% borrowing, 22% renting. Mortgage stress is not high, 19%. Rental stress is at 78%. And overall financial stress is relatively low. 77% are actually houses, 10% are units and other types of property. There you can see people ratio is just over 2. Vacancy rate was quite high, 9.4. That could be some second homes and Airbnb in a mix there. Gross investment yields 3.3. Net investment yields is minus 0.7%. Taxable income between $75,000 and $81,000 based on the census information and the ATO, giving a monthly disposal of around $4,700 with half going on the typical mortgage, $2,400, and 42% going on the typical rent. And looking at the scenarios, even the best case scenario is suggesting a small fall over the next 3 years, both for units and houses. The base case is a more significant fall. And just want to acknowledge this particular comment. Amazing how much info marketing gives out for free, yet the promotion on social media is how to be greedy, anxious, and destroy your life in the shortest possible time. Yeah, well, I do this because I actually believe there's a really, really important level of understanding that we need to pass. We need to get people to understand more about what's going on. And my frustration is that a lot of the things that go on really just are spruiking. You know, you look at the stuff in the media, look at the way that the media is connected to the property sector, and look at, once you understand who owns what, then you understand a lot of the stories are not necessarily objective and independent. I try to give the best view I can as to what's going on to help people make better decisions. And, you know, if I've succeeded, and helped a few, then I feel as though I've made my objective clearer. And, the fact of the matter is some people will say, hang on a moment, you're not telling the full story. Well, maybe I am, maybe I'm not. But I'm trying to go granular because I do believe that granularity is pretty important. Now, I've got another request here, 2146. So we'll go back to the display. And 2146 is in the Parramatta area, including Toongabbie. Not heard that one before, actually. Nice, interesting Australian name. I wonder what it means. If anybody knows what Toongabbie means, put it in the chat. Be interested to know. 26% own outright, 40% are borrowing, 33% are renting. A lot of mortgage stress, a lot of rental stress. And I should explain, of course, that 100% plus or minus a few, but it's a lot. And households in financial stress, 73%. So it's pretty significant. Looking at the mix, 63% of houses, quite a lot of units and other types of property there. People ratio is quite high, so this is going to be some households rather than individuals. Vacancy rates 5.8%. I've got nothing on the gross investment yield, so there may not be a huge amount of investment property there, but you can see there that I haven't got any reading at all for investing property. Interesting. Looking at the disposable monthly income, you can see that the taxable 74, household census says 110, so that's more than one income going to make the mortgage. And repayments, $6,400 with 40% going on the typical mortgage, $2,600, and 33%, $2,118 going on the typical rent. From a scenario perspective, because of this high stress level, even in the best case scenario, probably a small fall over the next 3 years is what I'm predicting through the scenarios here. Not a forecast, it's just an estimate based on the scenario. Base case, a more significant fall. And of course, there's downside risk if things go more difficult. Shell said, thanks for your insight, 4514. Sure, can do that. This is Stony Creek and Woodford. It's in the Moreton Bay North area. It's a little bit small count, so just be a little bit sensitive to just how accurate these are. I use a 0.5% sample, so that's not a huge count for this particular one. Nevertheless, we get 36% owning outright, 48% borrowing, 15% renting. And if you look at the mix of property, 97% are houses, small number of units. From a rental stress perspective, it's where the action is. There's not much mortgage stress that I can see. And overall financial stress is pretty low. People ratio is 2.47, so we've still got families here. Vacancy rate's 8.2%. Gross investment yield is 4.1, net investment yield minus 0.7%. And looking at the taxables, we've got ATO, 69,000 income, household census, 84,000, so more than one income going to pay the mortgage. And the disposal monthly is around $5,000, a bit more than that. 40%, just over $2,000 going on the typical mortgage, and 34%, $1,745 going on the typical rental payment. Rental stress is the story here. Nevertheless, if you look at the scenarios ahead, best case scenario is still a rise of property values for both units and houses. The base case shows a bit of a fall, and obviously if things go really pear-shaped, then prices would fall dramatically. But as I said earlier on, it rather depends on what happens with regard to government support. And Drew asked this interesting question. Thank you for the question, Drew. Where is the best money for value, state or area before you do 3,000, which, as you know, is a wind tunnel in Docklands with no one in the buildings? Yeah, we'll look at 3,000 in a second. So it depends, if you're thinking of areas from an investment perspective, as I've shown you earlier on, the returns are much better in Queensland, Western Australia, and in fact, South Australia is not bad. I wouldn't touch Sydney or Melbourne from an investment perspective. If I'm thinking of purchasing for long-term hold, then you've got to be much more careful, because it's more about individual suburbs rather than overall locales. There's values to be had in some areas, but generally, I still think property prices are significantly overvalued in many areas of Sydney and to a lesser extent Melbourne. I think property prices are still rather out of kilter in Tasmania. I expect to see more falls ahead there. There is still some value up in Queensland if you look carefully, but you've got to be really careful because people are being taken to the cleaners there regularly as well. And I actually think some of the best value is in some of the regional areas out of the major cities because their prices have not moved up anything like as much, and you still get a bit more land and those sorts of things. So it depends where you want to buy and what you want to do, I think, rather than anything else. So it's not an easy story, and that's why I think it's very important to go granular. And of course, I should say that if people want to get the full information for all the postcodes, that is available from DFA. And I'll tell you about how to do that. You have to basically sign up via Patreon, and you can get all of this information for every major postcode in the country, more than 2,000 postcodes. And that allows you then to do quite granular analysis, things like where property prices might move to, the gross net yields, the returns, all of those things, and even things like defaults. So that's the best way to get granular, is to use the data yourself. It is available, but as I say, it's a Patreon program and you have to pay for it. Now, if I then go to postcode 3000, which is what you mentioned, it's a bit of a worrisome postcode, this one. Let's put it back up on the screen. Postcode 3000. Okay, postcode 3000, centre of Melbourne. 23,000, 10% own outright, 11% of borrowing. But look at this, 78% of renting each. And those in mortgage stress, 5%. Those with rental stress, 78%, more than 14,000. Stressed investors, 68,000, so that's a big problem. A lot of people not making it very effective as an investor in the area. Financial stress is very, very high. No houses, well, 7 houses actually. 99% of units for other types of property. People ratio is a lot lower, a lot of individuals. But look at this, the vacancy rate, 32%. And as Drew said, a lot of people not living in property in Docklands and the surrounding area. Gross investment yield is 4.1, net investment yield is 0.4. Those living there, the average taxable is about 61 from the ATO, smaller amount from the census, giving a disposal monthly around 4,800, but 42% going on the typical mortgage and 38% going on the typical rent. And from a value perspective, falls, even in the best case scenario, prices are going to fall further in this area. And if the base case scenario works out, more significant. So this is, one of the hot spots when it comes to rental stress. One of the reasons why we're seeing a lot of investors selling in and around this particular area. Okay, let's see what else we've got. Cookie Boy's just made the point that Bitcoin's at 71,000. Yeah, well, I'm not going to touch Bitcoin today and talk about it, but, the halving is coming. And as we said on the show a couple of weeks ago, not surprising really, given that. But will it stay there? Who knows? Could be more volatile ahead, I think. We will see. Okay, 3042. And Hassan asked for that one, so let's have a look at that. 3042 is location Airport West, Killaloe Park, Nidri, in, of course, the northwest of Melbourne. 7,000 households, 40% own outright, 34% borrowing, 25% of renting. Mortgage stress at 83%. Ooh, that's high. Rental stress at 50%. Some stressed investors. Half of households in financial stress overall. And looking at the mix, 67% of houses, some units and other types of property. People ratios on the higher side, so these are some families. Vacancy rates at 8%. Gross investment yields at 3.7%. Net investment yield is 0.3% minus. The taxable incomes, 82,000 from the ATO, 96,000 from the census. So that means more than one income probably, giving around 5,700 as a disposal monthly on average. 44% going on the mortgage, 2,536, and 35.6% going on the typical rent, just over $2,000. And looking at the scenarios ahead you can see there that the story is that falls in value are likely ahead, houses and units, maybe 5 or 6% over the next 2 or 3 years. That's in the best case scenario. In the best case, a more significant fall. Our Cookie Boy said, Toongabbie is derived from an Aboriginal word reported as meaning place by the water or the meeting of the waters. Thank you for that. I've learned something today. Appreciate that. Okay. Big Ann asks, can I do 2750? And by the way, please like this stream if you've not done so yet, because it really helps to get the algorithm working for us. Please share, subscribe, get this information out more broadly. It's a really important set of information for people to understand what's really going on in the property market. So would appreciate that. Okay, so this is Penrith, 20,000 households, 26% own outright, 31.9% are borrowing, 41.6% are renting. Just over half are in mortgage stress and just 57% in rental stress. Overall financial stress, 42%. 65% are houses, 21% are units and other types of property, 13.8%. 2.23 is the ratio of people, so that's some families or as individuals. The vacancy rate, 7.1, a bit on the high side. And the gross investment yield is 3.2. Net investment yield is minus 0.8%. Average taxable, 76,000 versus 86,000 for the household census, giving a disposal monthly around 5,400, with 45.6% going on the typical rental payment, mortgage payment, and 35%, 1944, going on the typical rent. And looking at the scenarios, well, in the best case scenario, a small rise, 8% over 3 years for houses, slightly less for units. The base case, a bit of a fall, and obviously the worst case, a more significant fall. Okay. For 101. This is Highgate Hill in the inner city of Brisbane, 15,600, with 17% owning outright, 19% borrowing, and 63% renting. So it's renter central by the look of it. 70% in mortgage stress, 81% in rental stress. Stressed investors at 49%. Overall financial stress, 78%. Ow. 16% houses, lots of units, as you'd expect for an inner city area. Lower people ratio, so includes a lot of individuals as well as some couples and families. Vacancy rate's quite high. That includes a lot of students, possibly. Gross investment yield, 5.2. Net investment yield, 1.3. I make the point again, these investment yields are somewhat higher than some other parts of the country. Average taxable, 96,000. The census said 102,000, giving a disposal monthly around 6,900, with 34% going on the mortgage, 2,437, and 32%, 2,243, going on the typical rent. From a scenario perspective, even in the best case scenario, because of the stresses and strains we've got in this area, not much growth in the best case scenario. That's true for units and houses. The base case is a fall, and the worst case, a more significant fall. Now, Robert asked this question. It's a good question. Can you see where WA property boom going to bust due to a fall in iron ore and nickel? Well, WA is very exposed, of course, to what happens with regard to resources. The latest data shows that the iron ore price is falling. The stockpiles of ore that China has are rising. And so you could posit a theory that the mining sector will be easing back in the West. If it does, that's going to put downward pressure. However, I'll also make the point that a lot of people have migrated to the West and are migrating. Why? Because property is still relatively cheap compared to some other places, and there's still quite strong migration. So to me, the two-lever question is, what happens to migration? Will migration stay high? If it does, property prices could still continue to go higher, even with pressures from the resource sector. If, on the other hand, the resource sector takes the heart out of the West and migration eases back, then we could see property prices fall. And I would make the point that some prices are still not back to where they were a few years ago. Prices went up in the early 2000s, dropped back, and are recovering. But in some cases, properties are still lower than they were 4 or 5 years ago, and even where they were 10 years ago. Mandurah is a case in point. Okay, what else have we got? Well, thanks for the epic show. I love the news articles. Yes, Cookie. Well, thank you. You were very kind enough to provide me with them. And keep up the great work there, Cookie, because it really makes a huge difference in my ability to be able to cover all the issues. Now, AG put a super chat in. Thank you for 3102. So let's do that one. Thank you for the super chats, and Cookie for your super chat too. 3102, that's in Q East. So let's just put that back on the screen so you can see it. There you go. Okay, Q East in Melbourne, small count 2498 with 41% owning outright, 34% borrowing, and 24% renting. 46% in mortgage stress, 50% in rental stress, overall stress at 59%. 66% of houses, some are units and other types of property. The people ratio is 2.48, so that's families, not just individuals. Vacancy rate's relatively high at 8.6%, with the gross investment at 3.4, net investment yield at 0.3 minus. Looking at the taxable income, 118 versus 129,000, so probably multiple incomes going on the average disposable monthly income, giving 7690 or 46.8%. At $3,600 going on the average mortgage repayment, and 30% going on the average rent. From a scenario perspective, I'm afraid it's all downhill. So even in the best case scenario, a fall of 9% over 3 years, slightly less for units. In the base case, a more significant fall. I'm afraid that is the story for a lot of the areas in and around Melbourne. It is a bit of a story, and I think you're going to see that Melbourne is going to maintain its lead in terms of falls ahead. I'm afraid that's just the way it is. Now, Justice asks for 6230, which we will do. I'm going to probably have time for just a couple more, and then I'm going to close the show with a few closing comments. All right, so this is Carey Park in Bunbury. This is south, obviously, of Perth. 18,300, 29% outright, 37% borrowing, 32% renting, 73% in mortgage stress, 61% in rental stress, a bit of investor stress, 49% of households in financial stress. 8% houses, some units and other types of property there. People ratio is just over 2. Vacancy rate's quite high. That could be some second homes and Airbnb in there as well. Gross investment yield is 3.7. Net investment yield is minus 0.5%. And looking at the average taxable, 81,000 versus 76,000 for the census. And that gives a disposable monthly around 5,100, with 35% going on the typical mortgage and 29% going on the typical rent. And looking at the scenarios, best case scenario for houses up 12% over 3 years, slightly lower for units. Base case, a bit of a fall, and the worst case, a more significant fall. So that's the story of that one. Thank you very much for your question. Okay, I think Max Freedom asked for 6065. So this is tapping in Brand, again in the Wanneroo area, another of those high areas, high stressed areas. 23% own outright of the 24,000, 58%, ooh, that's really high, 58% borrowing, Mortgage Central, and 17.7% renting, 76% in mortgage stress, 84% in rental stress, overall financial stress at 60%. 92% of houses, some other units and other types of property there too. People ratio is 2.73%. The vacancy rate is 4.6. Gross investment yield is 3.8. Net investment yield is flat, 0. Average taxable, 78 versus the census, 110. So multiple incomes going to pay those mortgages. $6,800 average monthly income. 35% going on the mortgage 2400 and 29.2% at 1933 going on the typical rent. And looking at the scenarios, positive 9.9% over the next 3 years for the house, slightly less for the units. Base case a bit of a fall, depending on what you think. And Shell says, really appreciate you commenting here. Thanks for the awakening Australians to the truth. People need to share this channel far and wide. Yes, please do. Please share. Please get this message out. The reason I'm doing this is because I really want to show people that the story is rather different from what the mainstream media have been reporting. And it's very important that people make their own decisions, as we'll see as we come to the end of the show. And Jason, thank you very much for your super chat. Really appreciate that. And thank you very much for the contribution. Really, really appreciate it and your support as we do this. So let me just revert back to my closing thoughts with regard to where we go from here. What I've tried to do here today is to show you that, whatever you might believe with regard to the story of the property sector, there are some significant things that people need to know. And a lot of it is to do with the fact that people are really in a much more difficult situation. That situation has developed over quite a long period of time and won't be alleviated quickly. Even if rates start to come down, the fact of the matter is we are going to see people in difficulty. So I always say that it's really important for people to get their finances understood. So where's the money coming? Where's it going? Build a cash flow. Only half of households build a cash flow, have a cash flow. A lot of people have really no sense of where their money's going. Once you've got that, you can then prioritize. And I do think there's an important message here. You can't just rely on the government to rescue you or the bank to rescue you. Some of it's down to actually how you manage your own finances. But there will be people with significant difficulties who will need help. And one of the things that I think is important is to go to the right place for help. Don't just Google debt help, because if you do, you're going to end up in areas where people will charge you for advice and charge you to do things. There is free advice available, and I always recommend the debt helpline, 1-800-007-007. If you've got difficulty, that's government-backed, of course, and they've got some very good financial counsellors there. They are very busy, but it is an important source of information. So do keep that in mind. If you actually need assistance, they do help a lot of people to figure out what to do, because there are things you can do, but only once you've got a sense of where your finances actually are and prioritize. Look at the high debt or the interest rate on debt that you might have. One of the things I would say is that just restructuring isn't necessarily solving the problem. I see a lot of people restructuring and then still get into difficulty. I see people reach for more loans and then try and muddle through, but still get into more difficulty. It's really important to understand the money in, money out, which is why I measure stress in cash flow terms. Now, the other thing I'd just say as we sort of close out the show is you can get a lot more information about what I do and how I go about it if you actually go to my blog. The blog contains a lot of information, and you can also contact me directly via the blog if you want more information as well. Also, if you miss the opportunity to get a specific postcode in the show tonight, send me a message on the blog and I will send you the one-page summary for a postcode. No charge, just because I'm sharing my information. So you can contact me via the blog for that. I'd also make the point that if you want the full information set, that is available via Patreon. Now, there are various levels of support in Patreon, and I do appreciate all those who are supported by Patreon. It really must make a huge difference. And the one I really highlight is the $50 a month plus GST. That actually gives you access to the more than 2,000 data set points that you see as I went through the show tonight. If you want to get that, you can sign up for a month and get it, or sign up and get it each month for as long as you remain. And for those on Patreon, thank you for supporting me. And those in the $50 tier, I'm going to send this information out tomorrow now that I've run this show. So it'll be there shortly. And by the way, if you do feel able to support me, you can also do that via PayPal as well. I do appreciate all the support I get. It really makes it hugely important for me because I have costs to cover to do this stuff, and it really does help to make it possible for me to share this information at no cost on this channel. And also, of course, those who watch the ads and things like that, they all help to cover some of the costs of what I do. I don't do it to maximize profit. I do it to cover the costs of what I do here because, believe it or not, there are some costs involved. I will at some point make a show about the studio, by the way, because I've now got everything pretty much working. And I think that's pretty much it. Just to say that next week, there will be a chance to hear Tony Locantro coming back on again. Tony, of course, with his inimitable style, and we'll be talking specifically about what he's seeing at the moment in the markets. Quite a significant change from what we saw a few weeks ago, of course. So it'll be interesting to get his perspective. We can play Locantro bingo once again. And the dogs are still here. They've been up and around a bit. You might have heard them rattling. They've got collars on with dog tags, so they do rattle when they walk around. But they're there ready for lunch now. So that'll be my next task, and I will be looking forward to getting them out. The rain is still here, but it's not too bad. So there we are. Hope you enjoyed that. I hope you found that useful, insightful. I hope that it gave you a bit more of a sense of what's really going on in the property market and household finances. And I look forward to doing it all again next month. I do this once a month. Next week, Tony Locantro, and of course, check out my other shows during the week. I've also now started doing more shorts. So tell me what you think about those shorts, and go watch those shorts too, because they're under a minute. And I'm trying to sort of just pick out key messages and get those out too to help spread the word more. Please like, subscribe, and share all the information that we discussed here tonight. And I look forward to seeing you next time. This is Martin North from Digital Finance Analytics, signing off. Take care. Bye.